I feel younger. The world's looking a little whiter. And that's about it. So I can just say that it's just time is flying when we're having fun. I hope everyone had a great trading year last year. There was a lot here for everybody. And I think, that obviously, as my presentation tonight's going to show, we're walking into some wild continued. I don't think just because the clock stopped from one year to the next and we just start the game all over again. So anyway, we're looking forward to this year. And a lot of challenges, and that's the neat thing. It's just the hodgepodge and the melting pot of everything coming together. Now there's the wall of worry of Europe and the wall of worry of this, and everything's a wall of worry. The Fed's going to raise rates, and yes, there's still a lot of concerns, but man, I'm going to tell you something. At the end of the day, we still have to eat, sleep, rest, relax. We're addicted to phones. I really wish we would pass a law that people don't text and drive. That really bothers me, especially when you see that in Florida on I-95 from your mother who's 80. I'm just joking about that one. But any event, if you live in South Florida, you know what I'm talking about. It's the wild, wild west on the expressway. And needless to say, we're going to begin in just a couple minutes, and I think you're going to really enjoy tonight's presentation. I see my friend Dr. Jeffrey Scott in the room, so thank you. And hey, and David Kushner, you got our course from the last webinar, and I hope you go over that. But you got to go through that because that is incredible information. That course was that is stellar, and I'm telling you right now, David. I'm going to show you something. David, are you here with me right now? I'm going to cheat and show you something. Okay, did you go through, all right, did you get the mechanical breakout? Have you gone through that yet? So if you've gotten the, okay, so if you've gotten the basic, I mean, obviously there's it's an incredible amount of great information there. I believe that you're gonna, it's really helps put everything together. And with tonight's presentation, it kind of will mesh together, and we'll go through that. So I'm glad you are here, David. Thank you. All right. Well, give me 20 seconds here, and then we will hit the clock and hit all the recording devices. And so we'll re-record this. But our plan was to have this kind of a live presentation, short, sweet, to the point, show you what's going on and the big changes that have occurred in the world and what it really means to us. So, and Reg, Happy New Year. Thank you so much. All right. Well, I had a bell in my ear, and what that means is it's 8 p.m., so let's get rocking. Welcome, everyone, to Person's Planet. My name's John Person, and basically, we're going to go tonight through what I think is real important information and a game changer which might affect the markets, the way we trade, and some of the information that we use to make trading decisions. And I'll show you what I mean. It may be a little bit of a stretch, but it is and make no mistake, this is a historic situation. I don't know if it's being exposed enough, or maybe the ramifications. We'll see how it plays out. But, you know, I think you will agree with me that if you're provided with information or a set of facts, then you can come up with your own opinions and your own decisions. I think everyone will agree with that. If you're presented with facts, then rather than listen to some other conjecture of an analyst's opinion, you can make your own decisions with facts. And that's what I've always tried and strive to do when I teach people. I teach, number one, indicators that are logical. I teach seasonality with reasonable logic behind, and a lot of things that we talk about have logic behind it. So if you have facts, then you can kind of connect the dots and see that logic that's behind what it is that we're trying to analyze, and that's what I'm going to do tonight. Now, take a quick moment to read this disclosure. Trading is risky. We want you to as is still registered in the industry as a CTA. It's important that you see this important disclosure, and it is, of course, this information is educational in nature, and it is unlawful to reproduce, copy, distribute, and exhibit the material other than you guys watching it for your own educational benefit. Okay, So, welcome to 2015, and yet it has been one heck of an exciting roller coaster style trading environment, you've got to admit. Let's review what we've done so far in 2015, and man, we're just like 72 hours into the year almost of trading. If you think about it, 3 trading days is 24 trading hours into the year. The S&P 500 is down almost 3%. The 30-year bond prices, not yield, the bonds are almost up 3%. Ironically, note that the change in percentage from bonds to S&Ps, about the same percentage move, right? Crude oil, though, down another 10%. Now, we could sit here and try to make trading decisions from probability, statistics, mathematical calculations, looking at the means, moving averages, variance, of course, standard deviation. We could backtest strategies. We use seasonal analysis. If many of you have come and read my material, if you've bought my books on Amazon over the decades, and I now can say decades, that's pretty wild. You know, as co-author of the Commodity Traders Almanac for many years, you know, I've done a lot of work with seasonal analysis in the major markets and stock indices and stock sectors. We can try to prepare for a black swan event, but that's what a black swan event is all about. No one saw it coming, right? And of course, figuring random events is not a guarantee that you're going to make money trading. It's like, you know, like the cartoons kind of saying is, can we flip a coin? I mean, if you sit there and flip a coin, I mean, what's the probability, you know, is it really 50% that you're going to keep getting heads? I mean, so, you know, looking at a roll of a dice, we sit there and try to figure probabilities and statistics. We do that for one major reason. We need to get an edge, because the fact is nobody really does know. So we try to do prognostications. We try to say this is what's going to happen. I mean, just think, even myself, I thought mid-14 we would see a peak in bond prices. I'm still kind of right, because we haven't really exceeded the 2014 high in bond prices. But I think for the new millennium, at least for this mid-decade right here, we are experiencing this final test phase of a potential top in bond prices and a low in yield. Now, we don't have a guarantee of that, so we need an edge. Now, what's happened in 2015 when we first walked into the door trading? Well, the first thing is a historic game change event occurred. Whether you trade commodities or not, I want you to understand, if you trade ETFs, if you trade stocks, if you trade Exxon, if you trade Monsanto, if you've traded potash, if you've traded Hecla Mining, if you've traded a lot of commodity-based stocks and ETFs, this is something that is a historic game changer, and you might not be aware of it. But for the first time ever in history, the Chicago Mercantile Exchange and the commodity exchanges are charging traders for quotes. Now, the good news is it's been a lot of confusion for different people, and so I think what the main fact is, and where this would really integrate and hurt people. If you want to find more information, you can please visit the CM, and I posted the link here. Just go to cmegroup.com, market data, distributor files, blah, blah, blah. Bottom line, if you're a professional trader deemed to be either an FCM, an IB, a broker, a hedge fund manager, just a startup hedge fund, you're going to be paying $85 per exchange fee. That's $85 times 4, which is $340 a month. If you had an account prior to March last year, you're grandfathered in, it's about half of that, which is about $172. As a non-professional, which most people are, a speculator, you're going to be charged $5 per exchange, and here's the trick. It's capped out at $15. So if you only wanted the CME data, you'll pay $5 in quote fees. Now, there's even more, because it gets a little bit more confusing. There's the bid-ask market quotes, and then there's the dome quotes. And we're talking about dome quotes because most people want depth of market quotes. So why am I telling you this information? What does this have to do about anything? Well, a lot, actually. if you're a hedge fund or a startup hedge fund and you've got 5 guys in your office, all of a sudden you need quotes on all of these top 4 markets. Now you've got an office fee that instead of your rent, your electricity, everything else, now you got a fixed cost that just went up a little bit more. So startup hedge funds might be a little bit of a problem, right? And so that's one of the things. And then as a broker, if you own a brokerage firm, a small introducing brokerage firm, they're going to have to pay per broker's terminal. They have to pay those fees, and that will come out of a broker's pocket. So these are things that are not really being thought through. We're not sure how the ramification is, but I'll tell you what, this is what I kind of see, the cause and effect. Future commission merchants, FCMs, introducing brokers, IBs, and even new startup hedge funds will be charged per unit. Individuals holding multiple accounts. So let's say, you know how they always say, hey, always have a backup account in case, you know, connectivity or your brokerage firm goes down or something like that. You always have, you know, a backup plan. And I think everyone should. I've been teaching that for decades and actually have had multiple accounts across the spectrum of brokerage firms. Many of you know this. Now, I will be charged per account with the different brokerage firms. So if you have a brokerage account at one FCM and another one somewhere else, you're going to be charged that fee. So you have to say, well, you know, maybe I only want to get delayed quotes, and you got to figure this out. But here's the bottom line, the historic game changer. It's going to increase the cost of doing business. And here's what I'm afraid of, all right? How this affects the most important element of an aspect is right here, a startup new hedge fund. You know, we see people in the hedge fund industry come and go, and people are always trying to start up, you know, getting into managed money. Now, why is that important? Well, there is a report that you guys know that I utilize, the Commitment of Traders data, and it's incredibly informative and useful. And I'm going to share this with you right now. Why do I need the Commitment of Traders data? Well, from a psychological standpoint, if you think about it real carefully, if you're not sure what this report is, don't move. I'm going to show you why this is important. It really does share with us who's in control of the market, and it breaks it down into 3 categories. Ironically, it breaks it down to hedge funds, the large speculators. It breaks it down to commercials, those who are end users, either producers or end users who are going to make or take delivery of a product, and they use the commodities to hedge their risk in the cash market. And then there's this individual speculator. And so we use the Commitment of Traders data to help give us some better, maybe potential, an edge, better market analysis. It also helps us give an ability to anticipate market opportunities. And it gives us trade decision information based on one key element that I think every one of you want to get an edge: facts. We need facts, not opinion. Let's share some facts with you right now. Many of you have seen my presentations before, and I always kind of talk about my 12-step program to help determine better analytical skills. And you are familiar with my famed PPS buy-sell triggers. It's available on multiple platforms. Candle patterns. We all go down the line. Person's pivot indicator. It's a very useful tool to help determine direction, and then, of course, support and resistance for most time frames. And I use chart patterns and wedges and seasonal and cycle analysis, volume analysis, very key and critical, as I'll share with you again tonight. I have a little histogram that I have, and a little exclusive indicator at TradeStation. And I use relative strength. And when I say relative strength, I don't mean like the RSI indicator. I mean relative strength comparing one market to another, like comparing Coca-Cola with Pepsi, comparing the S&Ps to the Russell, relative comparative strength. We also call it pairs or spread trade analysis. But look at this one, number 9. Number 9 has always been there. Commitment of trader data for futures. It's very important. Of course, I use breadth analysis for stock indices, last conditional change, specific chart patterns, and last but not least, money management and position sizing guidelines. So let me focus on number 9 for just a minute. Why is this important? Take a look at this, friends. This non-commercial category describes what is a hedge fund. So we don't want to lose hedge funds, do we? We need hedge funds. They're still speculators. Not every hedge fund makes money. I'm gonna show you this in just a second. Look at then you have the commercials, and you have the non-reportable positions. Now this is just the Dow Jones Industrial Average futures. So just to show you something which is very important of what's going on in the market right now. What has happened in the market? Remember, I just began the presentation showing you what the percent changes of the markets were. Bonds up, stocks down, crude down. Well, if you're a hedge fund, you're not necessarily just in one market, unless maybe you're a market maker or you're just specializing one area. But most hedge funds are diversified amongst asset classes, which means they might be in S&Ps, they're probably in crude oil, they could be in bonds, most likely in gold, soybeans, etc., etc. So let's take a look at the market condition right now and see what's going on. Hedge funds. Look at this commitment to traded data and see what it shows. It's boxed in for us. This is as of December 30th, the close of business, December 30th. Here are the positions. The non-commercials, the hedge funds, long 35,000, short 19. So what do you get? A net 30% of that open interest number, the hedge funds were long. Huh, interesting. This is the E-mini S&Ps. This is a kind of an interesting number as well, because I want to share with you this open interest level right here, 3,267,000. About 3 months ago, that was 4,500,000. So we really dropped since September the open interest, the amount of participation in the market, especially as the stock market has been rising since that October low when the market shot up. That open interest has declined. But here's what's the most amazing part about this, all right? When you take a look at this, look at the longs of the small speculators and the shorts, all right? The longs and the shorts. They are long 259, they're short 256. It's like a net neutral. And here's, if we look at this line right here, percent of open interest, it says 7.9 versus 7.8. So even by looking at not the overall net position, but by looking at the percent of open interest to the percent of net long or short to the open interest, it shows pretty much neutral, 7.9, 7.8. All right, that's the small speculator. Let's focus on the pink box, non-commercials. This is the hedge funds. Why do we need the hedge funds? We don't want to lose the hedge funds. Funny thing is, if you look at this number, they are long E-mini S&Ps, 474 versus 339. They were net long 14.5% of that open interest in the S&P 500 futures since December 30th. So what does that tell us? Well, since December 30th, the market has not just gone down by 1%, 2%. We've seen about a 90-handle decline since December 30th, and it shows that the hedge funds were long S&Ps. Do you think if you had 90 handles long, would you be still able to maintain your positions and not go on a margin call? But wait, there's more, so sit back. And this is why it's important that we understand what the element is on hedge funds when it comes to looking at this data. Now, this is the bond market. Now, many of you might not trade bond futures, and as you can see, that's a fact, because look at the open interest, and it's so sad because I started trading bonds back in 1984, and it is so sad to see only 524,000. Gosh, we need interest rates to go up again. You know, wouldn't it be nice to just have a CD and make 4% on your money every year by just having it in the bank again? You remember those years? You know, that was like '02. You know, it wasn't just 12 years ago when we had some kind of an interest rate. But meanwhile, back on subject, not a lot of small speculators are in the bond market, but this is the category of small speculators. You know, give one for the Gipper, because the small speculator Look at this, 88,000 on the short side, but 115,000 on the long side. The small speculator is long bonds. Who's short? We need these hedge funds, don't we? Because the hedge funds, they were not by a huge margin, but 12% of that open interest, these guys, from a psychological edge, they're on the short side of the market. So it goes to show you that maybe not all the time are hedge funds right, and this time around, hedge funds have been caught with their pants down, literally, because since 1230, that's right here, the market was at 144. Look at that significant move. So you want to start adding these numbers up. This is the 29th, this is the 30th. From the 30th to today's high, that small little move out of nowhere is approximately, if you think about it, from around 144 to around almost 149, a $5,000 move on a one contract in bonds. So you've got almost a $5,000 move in the S&Ps, 90 handles, $4,500. You almost got a $5,000 move sitting right here in your face on a bond trade that you just didn't see coming, because the hedge funds, according to the government report, it shows us what the side of the position, the net side of the position, each trade category is in. If you noticed, in the S&Ps, small speculators, they didn't get wiped out in this. This is not a small speculator. They were like net neutral. In the bonds, the small speculators are long, for gosh sakes. So let's look about what probably is what you and I see as the most, one of the most popular, if not the most popular headline news across the globe. I don't care where you go, everyone's talking about what a relief gas prices are. True or false? Everyone's talking about it. Everyone says, man, did you see gas prices? Oh my God, they're down another dime. Everyone's talking about, and you know, it's kind of interesting, because when we start looking at this little report, I want you to stare at these numbers, guys and girls, because this is why we need the hedge fund community, because it just shows that not all the time are they right. By the way, look at the general public in crude oil. 91,000 long versus 80,000 short. In other words, 3.9% of the open interest long, 3.4% of the open interest short. They're hardly in the market, the small speculator. Not really in the market. They probably did the wise thing and sat it out for the holidays, waited for the new year to begin, and let's get giddy up and going. However, the hedge funds, look at this number, 18% of the open interest, and that is 2,343,842 contracts of WTI, New York Mercantile Exchange crude oil. Bob Pod said oil, that's the number one thing on the headline news. That's right. I don't know if this makes sense to you, but look at this. If everyone's student body is long, look at that 4-to-1 number. I mean, that is huge. So this is as of December 30th. You following me? They're on the wrong side of the stock market, wrong side of the bond market, and it's not just the S&Ps. They went with the Dow too. But they're hugely, as you can see, not that that's correct grammar, but hugely wrong and long. One of the highest that I remember in an awful, awful long time, that percent of open interest, 18%. That, my friends, is a pretty dramatic number. These guys, the hedge funds, were banking that crude oil would stop. So what do you think? When you hear on the news, when is the low going to come in? Here's my guess. Now, this is as of 12:30. And here's how we utilize this information to our advantage. Right now, there's a lot of talk. Now that crude oil's gone from almost over $100 back early this spring to now it's breached 50. Now everyone's an analyst coming out of the woodwork saying it's going to even 40. Okay? So we're going all the way down to zero, right? All of a sudden now. Well, the funny thing is let's take a look at crude oil and say from the 30th, where was this market? So that's as of the 30th, right? So if you think about the 30th, from 54 to 48, that's a $6,000 move. So they were probably building a large position in this consolidation area right in here. Be my guess. This was an area in here. I'm not going to say they bought the high, and I'm not going to say they bought the low, but building up into the 30th, this is where they started to amass, probably buy some in here, hedged, added some more, scaled in here. So I'm thinking, what happens if you're long from the 30th, right? And the 30th is, as you can see on the chart, right here. So if you're at that price level, and we go to this price level, and that's just a small, almost $6,000 move against you, how many different positions can you be in and get and sustain the types of move that we're seeing? So I wanted to put it in perspective of why is it important to see the hedge funds. Remember, not all hedge funds make money. You guys know that. You'll read the papers. You're going to see hedge funds performance in 2014. I'm going to bet, sure as I'm sitting here, I don't have to bet. I know a majority of you guys, exceeded and beat the market pundits last year. I know that. I already see a couple handfuls of people that I know had good years last year. I see your names. And if you want to say you beat the market, you can feel free to, chime in so people can see, and maybe we take an independent poll. I'm going to bet that it's the hedge funds that are having the biggest problem right now. And I think that's why we need the commitment of traders data. So here's how I use this information, and here's how you can use it. Number one, we use the commitment of traders data. It helps to confirm who's holding what in the market. And we can determine, as I just shared with you, we can determine a price move from the last report. It kind of helps to do what? Calculate that pain level. If we know that the hedge funds are long from a certain date on the close of 12/30, and you see where's the market today, you can kind of figure out, well, were they just long, or did they hold a long from the prior week? And of course they held longs from the prior week. So we can kind of use this information as a fact, not opinion, that the public's not in this trade. It's mostly the hedge funds. And when the hedge funds have multiple trades that they're in and they're wrong on for the majority, now think of it this way. Some are making money and a lot are losing money. 1 to 4 in crude oil, 100,000 short, 400,000 long. You do the math. More losers than winners. So at what point does that capitulate? How much pain can one entity take? I mean, I got to admit, a $6 move in crude oil since December 30th is an enormous amount of pain to take. Now, I want you to understand, when I took a look at this, I want to share this with you. Remember, I kind of teach people how to use this information efficiently. Number one, I have the commitment of traders data that I use the futures and the options combined. Why? Because what if I'm long the futures, but I bought a put for protection? I'm not really net long, am I? So therefore, I like to utilize the commitment of traders data as more of a statistical reference of who's holding what in the market, and that way it helps give me a guide. Think of this logically, of whether or not, combined with seasonal analysis, we can spot potential reversals. Now, what you don't know, or maybe you do, but towards the end of this month, a funny thing typically happens between the end of this month and the first week of February. About the best time of the year to go long crude oil is that week. Now, you got to give or take a week or so, and of course the conditions with crude oil, I think that this technical damage in what we're seeing here might just be forced margin call liquidation. I mean, I understand OPEC, and I understand oil production, and I understand fracking, but there's also that capitulation when you get into the investment world where people are long substantially, and then all of a sudden they have to sell because they're losing money and they're forced out of their position. And what happens is you get this cascading watershed factor, and that's why people scratch their head and say, hey, I don't understand this. Well, if you look at the facts, I think it makes a more logical sense. The reason we're going down is people are getting their accounts liquidated. I mean, in just a very short order of time, having that size of a net long position in a downtrend, this is a killer, and this is going to be very tough to trade out of starting 2015 for a lot of hedge funds. In fact, we probably won't have a lot of hedge funds that are in this. They've probably got blown up. Here's the problem. If they got blown up, now they got to start all over again, new accounts, and guess what they got to do? Pay the CME, new exchange fees. So they're going to get slapped with a little salt in the wound on top of it all. I don't know if that's a little humor, but sorry. I mean, that's the facts, right? I think that we get an edge, and as I started the presentation tonight, I think, number one, using my PPS indicator combined with other tools, it adds that edge if you can understand that once we see that technical pressure, that's what we have to start to guesstimate. What is the threshold pain level that you say, enough's enough, I'm out? Is it $2,000, $4,000, $6,000, $8,000 per contract amongst several different markets? Do you see what I'm saying? In other words, if you're losing $6,000 in crude, $5,000 in bonds, and all of a sudden in 3 days you have no chance to unwind that leverage because you're getting massive losses from all sides all at once, there's only one recourse. You got two recourses: wire more money in or liquidate the position. And that's what the media would consider technical pressures, because they don't want to say, oh yeah, guy's getting forced out of his trade, they're margin call liquidating him, right? When the money runs out of the account, they don't wait around for the wire to show up. They liquidate you, and then they say when the money hits the books, you can get right back into the market, my friend. And that's the facts of trading. So the commitment of traders data really does help us confirm who's holding what, and it gives us a great edge in understanding the dynamics behind the market. Now, if hedge funds were short and the small speculators held a very a small short position, I would be very concerned that this market can go a lot further to the downside. But at this point, it's kind of the opposite. I'm more concerned that the market's probably coming closer to the bottom, because once we wipe out that hedge fund liquidation, that net long position is wiped out, I'm thinking once there's no more selling, we could see a kind of a short, sharp potential reversal in the market. It wouldn't surprise me, you know, to wake up and see crude oil within the next week or two up $5-6. I don't think anyone sitting here that has been watching the markets would be surprised one iota to see a $6 move go up in crude oil in one day. I don't think anyone would be surprised. It's just how it would feed on itself, right? We'd all be sitting there going like, oh my God, maybe $4.80 or somewhere around there. We could potentially see, you know, an 8 to 10% move from $48. If you think about it, a 10% move from $48 is a $4.80 move. Big deal. It's just going to happen real fast. Once the sellers are wiped out, buyers step in. So this is where you can start to anticipate market opportunities, and that's what I wanted to share with you. Now, that's not the only trick up our sleeve, but I wanted to share with you some ways that I use and tools that I use to anticipate market opportunities. All right? Now, I don't want to see the hedge funds go away. I don't want to see people be charged to the point where they don't trade commodities and just trade ETFs. We still want to be trading the commodity markets because we get terrific information like this commitment of traders data free of charge. But if people aren't trading in the commodity market, then they can't get the data. Or if there's less traders in a market, it's not going to be as reliable. You might as well just trade, no joke, milk futures, okay? So that is one of the things that I want to say. You know, this last bullet point here, when I say there's other tricks up our sleeve, you know, I did a presentation a few weeks ago, last week, 2 weeks ago, in fact, and I talked about the dogs of the year. Negative performers into the middle of December tend to rebound sharply after the new year. once we see that tax credit selling pressure abated. One of the trades that we did, many of you may have been around for it, we tweeted out, in fact, we tweeted to buy Twitter. We had a nice little trade in Twitter. In fact, we did two strategies. We went with a long call strategy in Twitter, and we went with a credit put spread to 36.34 for around 62 cents. We wanted to get through the holidays and just look for a little theta decay. Today we covered that position. We tweeted that out. So we tweeted out getting into the trade. We tweeted getting out of the trade. So for those that had followed me on Twitter, I hope you enjoyed that. And this was one of the strategies and the trades that we actually put out. We also put out a few others that I think are lining up, and I want to share them with you tonight in case you weren't around, because I think this is going to give us some good opportunities going forward. Now, some of these are not obviously commodity related. This one is an old school favorite that many of you may find an interesting or boring. I'm not sure, whichever you want to say it. But this white hash line represents the last few years, okay? And if you notice what's happened with Sears, it goes down into the end of the year and it rallies. It goes down into the end of the year and it rallies. It goes down into the end of the years and it rallies. We went down into the end of the year, and not really, but we are moving lower into the end of the year, and we're just waiting for a little PPS buy signal. This is an interesting setup to me, because between the end of the year, December 31st, and April 1st, we've seen traditionally this type of movement in the retailer Sears. Now, why I think this year, I want you guys to pay attention to this, all right? As you can see, this is a weekly chart. This is Sears, and this is using TOS. We do not have an orange or blue arrow. Orange is a sell signal here. This is actually kind of an interesting pattern, and there's several different ways to play this. I would look for a breakout, a close above that level right there. On a breakout, I would look for that move to the upside, or I would wait to see if we get a PPS buy signal. Okay, we're near support. In light of how the overall stock market's traded, the fact that Sears hasn't really done anything in and of itself speaks wonders. Now, here's what I think's going on. This year, and you may remember last year, I don't want to get too fundamental, but a lot of people moved into apartments rather than buy new homes. And I think this is the year, as people start to save money to get out of their apartments into a home. You get a 12-month lease, so if you sign an apartment lease in April, you're not getting out until April, but you're going to start shopping for a home, and you're not going to renew that apartment lease. And I think that that's one of the things that we might be seeing. What's one of the components that people do? They go to Sears. But needless to say, it has strong seasonal analysis, and there's a little volume indicator that we use over here, OBV, that I like to teach people how to use. Note that the direction of the on-balance volume indicator, and notice the direction of price. They're converging. Volume's kind of going up. Price is sort of moved down. So it's actually spring-loaded for a potential move. And I'm not saying the stock's going to 100, but boy, if you got a breakout above, say, this 30, let's call it 35 level, right? You get a breakout above 35 and at least come back up to test this high in here, right? I mean, that's a lot of room to make a couple bucks. So moral of the story is, you want to set your alerts for that one. And I wanted to just, again, if you were here with me a couple weeks ago, I just want to follow with you for some of this. This one was another one we had on the list, was JCPenney. Now, I know you probably, JC person, come on, there's all kinds of great stocks out there. We got all these biotechs flying all over the place. The commodity markets are moving, and you got us looking at this stuff. Again, I don't care how you make money. It's what is the risk, and if you can define your risk, and what's the probability, and what kind of capital does it take to make the money. That's what's really important. Because anyone can say, hey, look, let's buy gold. But if you've got to risk $5,000, man, that's not a good trade to me. Low risk with a good position and high probability. And that's what I like to teach people, these high probability setups. Now, JCPenney's, by the way, just from a recent history, we have seen, and that's what this white line hash represents, we have seen, except for last year. Last year was the one year it didn't work in 4 years, right? But here's, if you notice, one common denominator. One common denominator. At the beginning of the year, it went down. You didn't get into it until you saw the PPS buy signal, and then you got the late stage rally. That's the interesting component. Now, right now, we don't quite have that going, or do we? And that's one of the things that I wanted to share with you, because today, while the stock market, I don't know, this is pretty sneaky, while the stock market plunged straight down, as we saw the hedge funds net long the S&Ps and the Dow, little lowly Mr. JCPenney stock, a $6 stock, was actually up almost 2% today. All right? So I would say if we can clear, and one of the other interesting elements is somebody doesn't think that this is that stupid of a stock, because you can start to see a little bit of accumulation in the volume, okay? So I think being up today, I mean, 12 cents is not a big deal relative. It's a $6 stock. But I'm talking about, you know, if everyone loved it at $8, then they got to love it at $6. And the fact that the relative strength outperformed the market speaks well and gives you an edge, knowing that almost in the last 4 years, JCPenney between January and April has gone up. So I think that's one of the things that we got to anticipate is the duration. Now what we need is to understand, is there a price pattern? Is there something that can give us a measured move, an objective, and how can we trade that, and what's our risk? Those are the things that we talk about. Now, the person's pivot indicator, and it's a very powerful tool, and it helps uncover that predetermined support and resistance. You know, we combine it with different patterns. Some of my favorite patterns, many of you know about the high closed doji, the low closed doji, you know, looking at how to trade M tops and, of course, W bottom formations, and, of course, the powerful wedge formation, which we actually have a little twist to that. It's a very, very unique way of trading the wedge formation. Many of you who took our trading course and we just offered, we had that mechanical trading system. If you haven't gotten through to that part yet, you better hurry, because I think we've got a lot of setups coming, and you're going to see exactly how to trade, how to define your profit objective, and where to place your stop. So if you got that course just 2 weeks ago, you better get on it. And I'll talk about that a little bit more at the end of tonight's presentation, because it is extremely effective. In fact, if you bought that trading course and you haven't really looked at it, there's a little something here. Now, I did not, for the record, take this trade, but it was the setup that's very powerful. This is a biotech company called Kite. And all the way up, this thing just, you know, popped off the charts, because it popped off, unfortunately, right during the New Year's Eve, which I have to admit, I had my my guard down. I was on vacation for that week. But needless to say, we're getting a lot of these types of setups in the market. And I think with the hedge funds out of the way in the energy complex, my friends, I think this is a pattern that we're going to have to be looking for, and start realizing we're going to have to start waiting and looking for some buy setups. When I talk about other patterns, I started this little pilot program at the beginning of last year, where I started to send tweets out about trades. This photo, the insert, is exactly the photo. You can go to our website. If you go to personsplanet.com, maybe I'll pop it up just for a look-see here. If you go to our website, personsplanet.com, you can go down to the tweets here. I think you can go even click on the Twitter logo. Like I say, click on the Twitter logo or not. And you can, there it goes. Okay, so Twitter. This was a trade we actually tweeted. It's kind of funny. We tweeted to do this strategy before the holidays. This is another thing that we're talking about, the declining wedge, but we wait for breakout, which we didn't get yet. Anyway, I put out some nice things every once in a while, but mostly what I'm doing is, as you can see here, on December 23rd, Twitter trade. We're taking profits on the long calls. We did two strategies. We went long a call, just an outright trade for Twitter before the holidays, and then we held a credit put spread for some theta decay in New Year's Eve. So this was, just an FYI what we're doing and going through. And you can go through and see some of these tweets that we've put out. Very informative. This is one that we put out back in September that talked about a broadening top with divergence in the advanced decline ratio line. And as you can clearly see, it worked out. It was, some really good stuff. We also, almost every trade I'm going to show you, you've probably seen before, were stuff that we tweeted out, but they're patterns that we use in combinations with other indicators. If you note here, when we talk about the PPS indicator or the patterns such as the high close doji, and I tell you, I like to look for combinations of buy signals near monthly support. This was the Russell. We actually went long. We were short the market on the way down, and we reversed and went long. Not only did we do that in the trading room, we actually sent a tweet out. On a side note, I'm going to say a lot of you guys, if you've never been to one of my webinars before, if you're using a volume indicator, if you're using the volume histogram, I just want to share this with you. If you notice that volume's going up and this indicator, OBV, is going down, many people might get fooled into thinking, hey, this trend has got more to go. And the funny thing is, if you note right here, there's a big change that occurred in the market. Whereas the volume might make you think that the market's going to continue to go down, but the OBV is confirming that actually price is gaining positive volume momentum. Anyway, this was another HCD. It was a long trade that we tweeted out back in October. And, there are so many patterns, just a few of them that I like to focus in on. Like, again, low close doji at monthly resistance, low close dojis at persons pivots. So looking at patterns and looking at that PPS indicator, and that's that buy-sell indicator. It's commonly referred to on Thinkorswim platform as the PPS indicator. Basically, it's a momentum indicator, and we use that in conjunction with other tools. We had some pretty stellar calls in this past year. Many of you probably remember some of this stuff. Like back in September, I remember we were a little early on the Q puts, and I got a little grief from some people because everyone's like, John, we're in the Q puts. When's this thing going to go down? And we got our answer. We actually added to spider puts. And then we reversed and we went with IWM calls. I bet you there's a handful of people here tonight that remember we had an open house last quarter. You remember we did the analysis on Qualcomm and Whole Foods? Whole Foods had what, about a 10%, 12% move after earnings, and we had that nailed down. Plus we did that Amazon trade. Then we had that little Apple that we tweeted out to be looking to sell at 120. That was pretty much the peak for a little while there, you got to admit. And then we just did that little Twitter trade that we just covered. When I tell you that there is some really good ways of defining price moves, it's not just the arrow and the momentum. It's a combination of direction of volume. This is what led us to understand that there was potential buying ahead of, and who in their right mind was thinking of going long QLogic. But we did. And QLogic was like one of the biggest earning surprises last quarter. In addition, JDS Uniphase, we were talking about this, and I'm so proud of this because I had, when I came up with this on my scans, when we had that PPS buy signal scan, I'm telling you right now, truthfully, I'm not bragging. I'm laughing because I just had a senior moment. I forgot who the hell they were. I'm like, JDS Uniphase, yeah, what do they do again? It was like a blast from the past of 2001 all over again, right? But yet, who in their right mind wants to trade JDS Uniphase when you got Triple D and all these sexy savvy? You got Tesla moving, you got biotech names flying all over the place, and here we have a low risk, high probability, incredible move based on both the momentum indicator and volume patterns. That, to me, I think, was a really important killer combination, and it just went one after the other. And just go through Whole Food Mart, just as a reminder. Whole Food Market gave us a buy signal a week before the earnings came out. The volume analysis, just to share with you guys, right? Look at the direction of price. Look at the direction of the volume bars. Look at the direction of price. Price is actually, if you look here closely with me, all right, because this is really a tip-off. Do you see, can you clearly see, yes or no, clearly see how the trend of the price over this weekly, again, this is bottom one's a weekly chart, because this is very important. If you don't think I'm going to be using the same techniques in the next couple weeks as we enter earnings season, you better think again. Look, and you better be prepared for these types of setups, because they're coming, baby. But look at that price direction of the downside. Explain to me why this yellow line is pointing up well before the price surged. All right? That, to me, is a dead ringer giveaway. And are there ways to trade that, and how can we anticipate? So this particular earnings season, we are locked and loaded with volatility already. I mean, we've wrung out some excesses out of the stock market. We've got earnings event around the corner. I mean, here was the one in QCOM, which, you know, the funny thing about that QCOM is that, you know, we weren't bullish on QCOM. We were bearish. We're sitting there going, you know, the stock, this price has gone up, and the volume's not gone anywhere. But yet, the same thing on a daily basis. The market's trending higher, and the volume's going down. It's not trending up. It didn't break out. There was no breakout with volume. And we also had that little PPS sell signal, and of course, bang, Qualcomm moved down. What's interesting about this was not luck. It was not about flipping a coin. It wasn't looking at probabilities. The interesting thing about Qualcomm is if you go back and you look at that November time period, Apple was going up, and everyone thought Qualcomm would go up with Apple because Qualcomm being a provider, you know, a part provider to a degree to Apple. And guess what? The opposite happened. And I mean, that was a pretty decent analysis combining the two indicators. Cisco, man's most hated technology company, John Chambers, you got to admit, this guy hasn't performed. You've heard about Cisco. But you know what? We didn't do too bad with Cisco. Guys in this room, I have students in this room right now. You guys know, this is stuff that was live, and we actually tweeted this stuff. So before it happened, which is a lot different. That's why I say when I did that Twitter program, it was a pilot program, I wanted to see if people would follow what we were saying and see if people could understand, you know, by the way, if you understand about Cisco, we have a bullish HCD pattern. You know, all you had to understand was HCD and know what it means. It's a good heads up. Amazon. Now, this was a great trade that we took from a buy, high close doji. Remember, I just talked about we look at different patterns, right? The high close doji pattern. This isn't from 1999. This isn't from 2004. This was just a few, I mean, literally not more than 10 weeks ago, right? And so by looking at how we can analyze the market, are there going to be trades out there using this style of analysis? I think it's going to continue this year because we are seeing the volatility, and I think that this is the analysis that seems to be working in the markets right now. It's really gelling. And you know, the interesting thing about this this chart that I want to share with you again, if you guys have been trading using simple volume bars, I mean, I don't know what the hell that tells you, but if I taught you how to look at this indicator down here correctly, and let's just pretend for a moment that this blue line is, pretend it's price. At this point in time, is it making a series of higher highs and higher lows? It is, right? And if I lied to you and said, oh, by the way, this is price, and it's breaking out, and it just broke out, and now we should see an expected little move to the upside, right? If you think about it, look where, from a line perspective, when did the breakout in volume happen? When did it take out the old highs, right? It happened here. It didn't happen up there. And what is this stuff telling you? What is this volume histogram sharing with you? If you have any idea, please let me know because I have no clue. All of this tells me it's average volume, but what this on-balance volume indicator shares with me is that what it is supposed to is that volume precedes price. And we not only saw Amazon, now it didn't stay there, but just for the record, Amazon went up to around 341, I think it was 41 or 42. What we did is we scaled out of that trade, all right? So that was an excellent pickup when no one saw it coming. It was based on the indicators and what I'm sharing with you tonight, all right? And the reason I'm doing that is because we had a game-changing event. And I don't want to see people get dissuaded because of a small fee in the markets. I want you guys to embrace the industry that we have because, man, if you can learn to wait patiently for the right setup and apply at least some logical position sizing guidelines, we are seeing some fantastic moves, and I'd love to share with you how to do that because I'm telling you right now, we got some amazing moves coming, and they've been happening. I mean, myself personally, we've done almost every single trade that you could see. It was busy, and we traded multiple times through the year. I've got a couple ones out there. We eked out a nice one in MGM, and by the way, I want to point out, MGM, we got about 6-7 weeks where you want to start paying attention to the casinos again, kids. I forgot to mention that. That'll be another webinar we'll do later. But a lot of these trades, almost all of these trades, Apple, the Amazon, the Russell, QLogic, TLT, Twitter, Whole Food Mart, we tweeted this stuff out before we placed orders, and we did that in that social media, what I call the pilot program to help individual investors. That little Twitter, I think what we did is we got up to almost 44,000 people following this event. So I must be doing something right. And, every once in a while, okay, it's not business, but we were in Las Vegas for New Year's. I went to see the Michael Jackson. I'm an old Deadhead. That's no secret. Love the Dead, love the Stones. I'm a rock and roll kid. But I got to tell you something. If you go to Vegas, go see this Michael Jackson show in Las Vegas. It's a must-see. It's at Mandalay Bay. So it is pretty amazing, good stuff. So I will give out, besides, the typical stuff, I will give out some specific trades and things of that nature. So I just wanted to bring that to your attention. I'm not all just business. I like to give out some version of some good stuff in life. Now, for you guys that saw me a couple weeks ago, I made a tremendous offer, and it was this special trading course, and we had a lot of people take advantage of it. We're starting the new year. By the way, yes, we were at the MGM party. Kelly Clarkson was there at the MGM party. That was very nice. I want you guys, if you're really serious about getting an edge in the markets this year, I have this brand new study course. It is going to be, and it was, we're putting it back for $189. It's how to trade the PPS indicator. It's approximately 4 hours of instructional information. It is a lot of details talking about the best time frames to combine using the PPS indicator combined with person's pivots, the practical purpose for why we have those moving averages overlaid on prices, how we use the projected support resistance to target the market trend, why we use the pivot point level in of itself to define trades, how to set up and scan for trades using PPS. Now, if you don't have TradeStation, if you're a Thinkorswim customer, this is ideal for you guys to scan for trade opportunities using the PPS indicator. It's without a doubt right there. Learning how to run the scans is fabulous. It also tells you not just the scans, what comes up, but how you can look for scans and see what the sector analysis is doing. So all of a sudden, if you start to scan for buy signals, all of a sudden you see 2 or 3 stocks you're not familiar with. You can just look them up. Maybe they happen to be REITs. By the way, this is the information we shared yesterday. While the stock market was crashing yesterday, the real estate investment trusts, there's just a couple dozen were all popping and just taking off. So not all stocks are going down. I think what we're seeing is a little, believe it or not, some rotation going on, and I'm not convinced that it's the end of the world. I'm not all that outright bearish right here, still just for the record. We also use which technical indicators work best in conjunction with PPS. A lot of people have come to me saying they use Bollinger Bands, they like to look at the bands, and they look at the squeezes. And I know, John, I've used Bollinger Bands for now 2 decades. How to integrate Ichimoku cloud charts, that's also kind of an interesting component of how the PPS integrates with these 2 forms of analysis. And I go through very in-depth teachings on those 2 points. So if you're interested, my favorite aspect of what we went through tonight was how to integrate the volume analysis with the PPS indicator. And again, how to use comparative and analysis trick using PPS with cash and futures markets. Once again, futures markets. Futures, if you're a spider trader, if you're trading OEX, man, you got to still use the futures information. Now, this was the course for using PPS combined with Person's pivots. For more advanced traders, we also have what I think everyone should get and learn how to trade this mechanical breakout system. This is the PPS breakout system strategy. Similar to Wedge, but it gives instructions for placing entry orders, stop loss, setting profit objectives, instructions for scale outs, instructions for trailing your stops. We talk in detail. First off, you got to know what the last conditional change, what we consider to be the LCC method, the last conditional change. Last conditional change is very important in this methodology, and you have to understand how to do this right. So not only do I teach all of that and how to use that method for end of day and weekly time frames and how to set up for buying and selling strategies, but we look to see how to apply this breakout method for options trading, because I'm going to tell you something that is dynamic. How to select the right strike price and how to select the right expiration date. You know, we just did a trade today in USO, and I think from a very small position in USO, I want everyone, I'm going to leave you with this too. There's a couple, if you do this, there's a couple things that you may want to also examine in crude oil very shortly and keep your eye on it. If you're into ETF trading, I want you to take a look at a 3-time ETF. It's the E, and I know there's a ton of ways of trading a market. The ERX, okay? That's a 3-time leverage bullish ETF. And the other one is the UCO. That's really horrible handwriting, but I'm sorry. It's the UCO. ERX, that's a 3-timer, and this is a 2-timer, okay? So when you start to see a bullish bias, when you start to see confirmation that the market's moving, unless you have an order in, it's going to be tough to get into the market. But to take some measuring and profit objectives, I think these 2 ETFs, they're the interesting aspect. I want to share this with you. Let's take a look at UCO real quick. I teed this up. Look at the February. I mean, granted, it's got some decent volume as an ETF. It's an $8 instrument, right? I mean, today it was down 76 cents. But look at this, guys. I mean, open interest, someone's feeling a little love there with the 2,300 open interest. Today's volume alone was 800 contracts. Not a lot, but for, you know, small, 10, 5, 15 lot traders, I mean, it can handle that type. Bid and ask, I mean, you got to admit it's not that bad. But here's what I wanted to share with you guys. Go out one, instead of looking at the Feb, which is 45 days, you might want to look at this April contract. You know, for an ETF that no one seems to be wanting to pay attention to, look at today's action. There was a little bit of volume right there, more so than on the put side on the April. A little more bias on the UCO, which is a 2-time ETF. So I just wanted to make sure that you guys had some information. I know that the biggest headline news is crude oil. I mean, it is something that I would be concerned about. I think even if it went to 45, it's a matter of how many minutes will it stay there. And I think it behooves us to take a look at that commitment of traders data, as well as the essence of the seasonal tendency of supply-demand functions of the market. Just because we all had a good time for New Year's and didn't go, many people might not have gone somewhere or whatever. We're going to start to travel soon. Winter break's coming up, baby. People want vacations, and you're going to start to see that travel. So don't discount a sharp reversal coming in crude oil. You want to be positioned for it. And I'm telling you right now, we've got some of the best educational information to help you kick 2015 off. If you're interested in taking both courses, we have a bundle price for you that is just a fabulous value for just $489. I'm going to tell you, snatch this up. You're going to love it. Here's the best part. I'm going to get together with all my course members, and we're going to have a one-on-one webinar together going through the information and potential trade setups that have occurred and past trades that have occurred, and go through the right selection method and answer all the questions. So the first thing you got to do is you get it. The second thing you got to do is you got to study it. Start the new year off right. The third thing is you and I get together. We rub elbows in our trading room right here, but we do it in a private mentoring session with me. We're going to do that, and we'll send an email invitation out to all our course buyers. So this is a great way to start the year off. The link's there. I wish you well. I hope you found a lot of insightful information in tonight's presentation. And to be honest with you, I really am excited about 2015. Not the fact that I'm going to be one more year older and the fact that the Y2K is 15 years behind us, but I think it's really an enjoyable industry, especially all the products that we have, the volatility and the uncertainty that's still in the air. And, you know, I just think that we've got some real exciting ways of capturing moves. You got 12 months, wait for the right setup, and be well positioned in that trade, believe in that methodology, and I think you're going to come out way ahead again this year. I want to wish everyone not only a prosperous new year, but a healthy new year. And man, let's get that flu season behind us, shall we? So that is a bundle package. You have a choice. You can get by the end of this week. This is going to be the last offer that we have for this year at that price. It's done because I'm only doing one mentoring session with you guys, right? So if you want to get just the PPS indicator combined with person's pivots with all of this analysis right here, if this is what you want, it's only $189. If you want to learn this information combined with my mechanical breakout system strategy, combined is only $489. You get both for $489. So with that said, everyone, have a great evening. We'll send you a link. Enjoy. We did record this. It should be out perfect. Sound was great. The audience, you guys, were awesome. And I think it was just a nice way to begin the year. So I want to say thank you all very much, and thank you for being here with me, because I know, I mean, it is on a Tuesday night, 9 o'clock Eastern Standard Time. You guys have other things to do, I'm sure. So thank you, and I hope you found good value in tonight's information. The link is should be posted right there, and I'll put it back in the room. And I hope to see our paths cross if you come out to one of our seminars. We'll be actually doing a seminar at Aria Casino in May. We'll be out in Las Vegas doing a typical live trading seminar in May. So I look forward, if anyone's interested in that. You can always visit our website, find out where we'll be. We're going to be at the Money Show. I'll be speaking about most likely you know, how some of these trades will work out. We'll talk about what we tweeted out. And for those guys and ladies and gentlemen that took the Twitter trade, what a way to start the new year. Woof. Anyway, it was good stuff. So, and by the way, I mean, just to prove that not all things are bad, the stock market's down 3%. Twitter was up 6.5% today. So anyway, thanks everybody. Behave. If you don't behave, don't get caught. It's 2015. Live life, man.